Hi Kishore.
Hi, sir.
Edward Raj, Prabhu, Venkatesh, Abbas, Prakash, Gautam, Monish. Can you just switch on your camera for a minute? Okay, thought that we'll see you, but none of you switching on your camera. Okay. Okay, then shall we start with the class?
Yes, sir.
Okay, sure. So today we are going to talk about the subject advanced accounts. In that advanced accounts, I will start with the chapter partnership accounts. So you have studied partnership accounts at various levels earlier, either in graduation or in your higher secondary or in your CPT. So or foundation course, whatever in which stream you have come from. So now we are going to study about some advanced features in partnership accounts. So what is advanced? So in partnership accounts, we would have seen that what is a partnership firm. I'll just share my screen. So it's taking a little bit of time. There's some issue with Google Meet. Just give me a minute. Okay. Are you able to see the Excel sheet now?
Yes, sir.
Yes, sir.
Yes, sir. Okay. Thank you. So now we are going to talk about what is a partnership firm. We would have studied already what is a partnership firm. What is a partnership firm? Basically, it's a form of business in which there are two or more persons coming together. They are called as partners and they carry on a business. The business will have a name. That name of the business is called the firm. So the owners of the business is called the partners, and the business itself it has some distinct name, and it will be called as the firm. And what is the purpose of carrying on this business? The purpose of carrying on the business is to share the profits, to earn the profits, and to share the profits. The profits will be shared between the partners in a fixed profit sharing ratio, and there is a unlimited liability on the partners. What is the meaning of unlimited liability? If there is a loss in the business, not only the business assets, even the private assets of the partners are liable for the creditors. For example, there are some two partners A and B, and they have started a business. Let's assume the name of the partnership firm is Saravana Stores. And in this Saravana Stores, they are introducing a capital of 50,000 each. So 50,000 partner A will bring in and 50,000 partner B will bring in. And the total capital will be 1 lakh. So what happens with this 1 lakh? They will do the business. If there are profits, they will share equally. It is how we decide the profit sharing ratio. It is based on the partnership deed. So whatever is the rules and regulations according to which the business has to run, they will be mentioned in the partnership deed. If the partnership deed mentions that A and B will share the profits equally, then for example, if their first year profits are 10,000, then A and B will share it equally 5,000 each. But suppose if there is a loss, usually the profit sharing ratio and loss sharing ratio is the same. But again, the partnership deed can say otherwise. It can say that whatever profits there, A and B will share equally. If there is a loss, A will take it 100%. Such a partnership deed also valid. So what happens? Sometimes there will be a loss in the partnership firm. Let's assume the losses, accumulated losses of the partnership firm becomes 1,50,000. How much is the capital introduced? 1 lakh. Now how much is the loss? 1,50,000. So whatever amount invested in the firm, it will be wiped out. Apart from that, there will be a 50,000 creditors. Then what happens to this 50,000? If it was a company, in a dissolution of a company, whatever assets available with the company, we will sell, and out of that proceeds, we will settle the liabilities. All other liabilities will be written off or waived. The creditors will lose the money. The shareholders will not be asked to bring in additional money. But in a partnership firm, our capital was 1 lakh. We made a loss of 1,50,000. So there is an excess loss of 50,000. In this partnership deed, we have seen that Mr. A has to bear the entire loss. So he will have to bring 50,000 from his private assets. Apart from the capital he introduced to the firm, he has to bring money from his other sources. So it will be an unlimited liability. He cannot escape this unlimited liability. These are the basic features of a partnership firm. In this partnership firm, you might have studied about how to prepare accounts for partnership accounts. So what is the difference between a proprietorship and partnership accounts? Mainly, there will be capital account and partners drawing accounts. That is the unique feature of partnership accounts. And whenever there is a profit, you will be sharing it in the profit sharing ratio. If there is a loss, you will be sharing in the loss sharing ratio. And there will be admission of a new partner. And there will be a some partner will be retiring. Retirement of a partner will be there. Death of a partner will be there. All those things you would have studied earlier. But now our focus is on dissolution. So in the life cycle of a partnership, the first thing is formation of a partnership, then doing the business, and after that there'll be a admission of a partner, sometimes retirement of a partner, sometimes reconstitution of the firm. Some partners exit, some partners come in, and sometimes death of a partner will be there. All these are covered earlier. Now we move to the fag end of the partnership firm. What is the last step in the life cycle? It is shutting down or closing up of the partnership firm. So here we need to differentiate between what is a partnership and what is a partnership firm. Partnership is basically the relationship between the partners, and the partnership firm is the business of the partnership. For example, there are two partners, A and B, and they start a firm called Saravana Stores. So the partnership is between A and B, but the firm name is Saravana Stores. They will be dealing in their own business. If there is a change in partnership, for example, there is Mr. C who is added to the partnership, then the partnership will change. The existing partnership between A and B will uh, stop to exist, and there will be a new partnership that will come into existence. That is, A, B, and C will become a new partnership, but the business around us, it continues. So the firm continues and the partnership changes. Similarly, if there are three partners A, B, C, D, if you admit fourth partner D, the existing partnership between A, B, C will stop and new partnership will come into existence between A, B, C, D. And if partner A dies or he retires from the firm, the partnership will end and the new partnership between B, C, D will continue. However, the business, that is Saravana Stores, will not stop. It will keep running. Even though many partnerships have ended, the firm will not end. It will keep continuing. So now we have to understand between the difference between dissolution of partnership and dissolution of partnership firm. So what is the first point? Dissolution of partnership occurs. Just a minute. So dissolution of partnership occurs in various situations. What are those situations? First is expiry of the term. Sometimes the partnership is constituted for a particular time period. So if the partnership deed is constituted for, let's say, the partnership will continue for a period of 5 years. On the expiry of 5 years, the partnership will end. Then sometimes the partnership is constituted to complete one particular venture. For example, construction of a road or construction of a building or a dam, like that. So it is only for a particular venture. Once the particular venture is completed, the partnership will end. Then death of a partner. If a partner dies, then the partnership ends. Then in the case of a insolvency of a partner, what happens when some partner become insolvent? He stops being a partner. It's automatically by law, he stops being a partner in the partnership. Immediately he will be discharged from his liabilities. What is insolvency? Insolvency is something when a person's liabilities exceed his assets, and the creditors will be force him to repay their money, but he'll not be able to repay. If he is hopeless and he doesn't foresee that even in future he'll be able to come back and repay the money, then he will apply to the court saying, I have taken so much of loan. Let's say I have taken 10 lakhs of loan, but my assets are only 5 lakhs. But these creditors are daily forcing me and torturing me to repay the money. Please give me a freedom from these creditors. So he will apply to the court. The court will appoint one liquidator. He will take up all the assets and liabilities, and this person will be declared as insolvent. If any person is declared as insolvent, henceforth no creditor should make any claim to him. They can make a claim only to the liquidator. The liquidator, what he will say, his assets are 5 lakhs, but liabilities are 10 lakhs. So I will pay 50% to each of you, and you have to waive the other 50%. Like that, the liquidator will make an arrangement. After that, this person becomes insolvent, and no one should disturb him. So, in the case of a partner, if he becomes insolvent, then immediately he ceases to be a partner. The partnership cannot claim any money from the insolvent partner. They can claim only with the liquidator. The liquidator will see his asset and liability position, and he will pay them ratably. So that is the implication of insolvency of a partner in partnership. Now we will see what is a dissolution of partnership firm. So here the firm means the business. For example, Sarvana Stores here. So Sarvana Stores is a firm. Even though many partnership changes, the firm continues. But at some time, at the last stage of partnership, the firm itself, the business itself is closed down and the firm is dissolved. So, in which situations it is dissolved? One situation is when partners agree for dissolution. When it is partnership deed is not for any particular term, it is not for any particular venture. They say the partnership at will. So, whenever they decide and they agree for dissolution of the not only the partnership, the dissolution of the firm itself, then the firm is dissolved. Then all partners except one becomes insolvent. We know that for a partnership to be constituted, there should be minimum 2 people. In this case, all partners except one becomes insolvent. So there is no partnership. The firm gets dissolved. Then when the business becomes illegal, the very purpose of forming a partnership is to run a business for a purpose of making profits. So in this case, when the business becomes illegal, the firm should be dissolved. Then partnership at will, and partner gives notice of dissolution, and court orders dissolution. Sometimes the court itself will order that the firm has to be dissolved. In various situations, courts will say that the firm should be dissolved. What various situations can dissolve a partnership firm? The one situation is where a partner has become unsound mind, and another situation is when a partner suffers from permanent incapacity. So he has a mental or physical incapacity. If it is permanent, the court may order the firm to be dissolved. Or when a partner is guilty of misconduct of the business, or where a partner consistently disregards partnership agreement. Why there is an agreement? We have to abide by the agreement. We have to follow the agreement. If a partner persistently, continuously, he doesn't bother about the partnership agreement, and he acts according to his whims and fancies. So in those situations, the partnership agreement will be ending. The court will say, enough is enough, you dissolve the firm itself. And when a partner transfers his interest or share to a third party, it's not a transferable interest. A partner, he cannot give his right of partnership to another person. If suppose anyone is transferring this, then the court might order dissolution of the firm. And another situation is where a business cannot be carried on except at a loss. The main purpose of running the business is to make profits. If it is known that in future there will not be any profits, there will be only loss. In such situation, court may order dissolution. And for any other reason where the court feels that it is just and equitable, that the partnership firm to be dissolved. So these are the situations in which a partnership firm will be dissolved. So any doubts so far? No. So you are clear about what is a partnership and what we are discussing today. We are discussing about dissolution of partnership firm. So what are the consequences of dissolution? So what happens? We say dissolution. Once we do the dissolution, what are the various consequences? The consequences are that one, we have to dispose all the assets. The assets can be disposed of either to the partners or outsiders. A firm will have various assets. What will be the various assets? It may have some land, building, machinery, furniture, electrical fittings, stock, cash. All those assets should be disposed of. All assets should be sold. It can be either sold to outsiders or it can be sold to the partners also. And then we have to pay all the liabilities. While paying the liabilities, there is a certain order in which we have to repay the liabilities. The first thing is that you have to pay out all outside liabilities. What is outside liabilities? Partners are called the owners or insiders. All the other liabilities are called outside liabilities. If we have to pay some creditors, if we have to pay some bank loan, if we have to pay some salary or electricity or whatever, all those outside liabilities should be repaid first. Then once we repay all the outside liabilities, next thing is we have to repay the loan from partners. These are not the capital, these are the loans. If there are any loans outstanding from the partners, we have to repay them. Then the next in the order is we have to repay the capital from partners. Then if there is any surplus after repaying everybody, then it will be shared between the partners in the profit sharing ratio. So this is the consequences of dissolution. You will sell all the assets, you will repay all the external liability first, then loan from partners next, and the capital of the partners. You will be left out with some money that also you should distribute to the partners in profit sharing ratio. So by doing this, we end up closing out all the assets, all the liabilities. So all the ledger accounts in the partnership firm will be closed. So it means the books are closed and the firm is closed. Then we'll move on to application of firm's assets. So in which order we have to apply the firm's assets? First thing is we have to dispose all the assets and we have to take the money. Out of that money, we have to pay external liabilities first, repay the loans from partners, then repay the capital from partners, then the surplus is shared in profit sharing ratio. So this is the order in which firm's assets are applied. And if there are any losses and deficiencies, how to deal with them. So losses and deficiencies have to be first, they have to be met out of profits. Then second, they have to be met out of capital. If the capital is also not sufficient, then we have to demand contribution from the partners. So the partners will have to bring money from their private sources, from their private properties. They'll have to bring out the money to square off the losses and deficiencies of the partnership firm, because this is the concept of unlimited liability. So if you are clear, then we can proceed. What are the various steps in accounting for dissolution? So we have discussed about various concepts. Now we can move forward to the various steps which are involved in accounting for dissolution. Shall we proceed?
Yes, sir.
Yes, sir.
Okay, sure. Thank you. So there are various steps in accounting for dissolution. So what is the first step? We have to open an account called realization account. This is a ledger account which we need to open as soon as there is a dissolution of partnership firm. So the second step is we have to transfer all assets except cash and bank balance to the realization account. Cash and bank balance, we should not transfer it to the realization account. All other assets, by whatever name it is standing in the partnership firm, we have to transfer everything to the realization account. By doing this step, the ledger accounts of all the asset accounts will be closed. They will become zero. So once we transfer all the assets, then what we need to close out? We have to close out all the liabilities except partners loan and partners capital accounts. So all outside liabilities will become zero after this particular step. Everything will be moved to the realization account. The next is we have to credit the amounts realized by sale of assets. We have to sell the assets one by one and we have to credit the amounts to the realization account. So welcome Priyanka. We are discussing about dissolution of partnership firms and we are discussing about various steps in accounting for dissolution. So now we are moving on to the step number 5, where we have to credit the value of assets taken by the partners. So the fourth step is when we sell the assets to the outsiders. In that case, we have to credit the amounts realized by sale of assets. In the case the partners are taking over the assets, then we have to credit the value of assets taken over by the partners. Then we have to debit the amounts for which liabilities are settled, and we have to debit the amount of liabilities taken over by the partner. Sometimes the partners may take over the assets. For example, there is a car which is regularly used by one particular partner. He will not prefer to sell the car during the dissolution. He will say that I will take the car myself at the book value or above the book value or below the book value. Basically at the price discussed and decided by the partners, he will take over the car. Similarly, sometimes the partners will say that I'll take over some of the liabilities. So if there are some liabilities taken over by the partner, then we have to debit the realization amount account for the amount at which the partner takes over the liability. Then realization process might involve some expenses. So all those expenses should be debited to the realization account. And after that, we have to transfer realization profit or loss to partners capital account. This will be done at the profit sharing ratio. So what is the process of realization? We are selling the assets and we are settling the liabilities. When we are doing this, some of the assets may sell at a profit. Some of the assets might sell at a loss. That is basically more or less than the book value of the assets. Similarly, sometimes the liabilities also, they are settled at sometimes at a higher amount, sometimes at a lower amount. So there will be a profit or loss. So all of them combined will become a realization profit. So such a realization profit or loss should be transferred to the partner's capital account. After that, there is a next step. What we have to do? Initially, we have left out cash and bank balance in the case of assets, partners loan and capital in the case of liabilities. Now we are moving to that particular step. So what we need to do? We have to repay the loans taken from partners. After that, we have to repay partners capital. So by this, loans and capital of the partners will be closed out. Our cash and bank balance also will come to a very meager amount. Sometimes they become zero. But sometimes what happens is there are some deficiencies. The assets available in the partnership firm not sufficient to cover the liabilities. At that time, we have to recover the deficiency from partners. So by this, capital account of the partners will be closed and cash and bank balance also will be closed. So by doing these 12 steps, all the ledger accounts in a partnership firm will become zero, will not be having any balance. So effectively, the books of the firm will be closed and firm's business is also closed because it doesn't have any asset, it doesn't have any liability also. So this is the various steps we have to do in the case of accounting for dissolution. Once you remember all these steps and execute that, then that's it. You will complete the dissolution dissolution of firm sum in a exam. Any doubts so far?
No.
Okay. So then now we'll move on to see how these steps work out in a practical situation. So now we'll move on to the study material. We have the unit 1 where we covered what is a partnership firm, in which cases a partnership is dissolved, in which cases a partnership firm is dissolved, and we have seen that what are the various consequences, what happens when there is a dissolution of partnership firm. Then we have seen the process of closing of partnership books on dissolution. So this is the actual entries. We have seen the various steps, but actually how it is done, it is done in this particular way. The specimen of realization account, how the entry should be made. The first entry is for transferring the assets. What we have to do, we have to in the realization account, we have to debit the various assets, excluding the cash and bank account, and debit balance in partner account. Debit balance in profit and loss account, partners capital and loan accounts. So except that, all assets we have to transfer. On the liabilities, you have to transfer to the credit side of the realization account, saying by sundry liabilities, excluding the credit balance in profit and loss account, partners current account, capital account, and loan account. Except that, all other liabilities will be credited to the realization account. And any realization expenses should be debited to the realization account. And any amount paid for settling the liabilities, it has to be debited to the realization account. Any expenses or liabilities paid by the partners, you have to debit the partners capital account. And if there are any profit on realization, that should be debited here. And on the credit side, then any amount realized from assets and unrecorded assets, it has to be credited. Any assets taken over by the partner, it has to be credited to the partner's capital account. And any loss on realization distributed, it will be on the credit side of the realization account. So this is a specimen of a realization account. And there is a treatment of goodwill. This we will take up little later. So now we'll take up a example. There is a balance sheet of Mr. Fast and Quick as at December 31, 2021. Then liabilities, sundry creditors 20,000, Fast loan 10,000, general reserve 10,000, and capital accounts of Fast 30,000 and Quick 25,000. So there is a total of 95,000 on the liability side. Then on the asset side, we have various assets: plant and machinery 40,000, patent 6,000, stock 25,000, sundry debtors 19,000 less provision for doubtful debts 1,000, net amount is 18,000, and cash 6,000. So total assets 95,000. So now they say that Fast and Quick share profits in the ratio of 3:2 On 1st January 2012, the firm was dissolved. Fast took over the patents at a valuation of 5,000. The other assets realized as under. So patents taken over by one of the partners Fast for a value of 5,000. Other assets, plant and machinery sold for 45,000, stock 22,000, sundry debtors 18,500. So total cash realized is 85,500. And the additional information is that the sundry creditors were paid off at a discount of 5%. The expenses amounted to 3,500 realization expenses. So now we have to prepare the realization account and we have to close out the books of the accounts of Fast and Quick. So now what we have to do? We have to see what are the various steps. So steps in accounting for dissolution. First is open realization account. So this is the first step. So what we need to do? We have to start with the realization account. Now we will proceed with both preparation of journal entries as well as ledger account side by side so that our understanding will be better. So let's start with the journal entries first. So what will be the journal entry? For transferring all assets except cash and balance to realization account. So that particular journal entry we have to pass first. So let us see what are the various assets and liabilities of Fast and Quick. He has plant and machinery. This we can transfer. Patents we can transfer. Stock we can transfer. Sundry debtors. In the case of sundry debtors, we have to be careful. So what is the gross asset amount? The gross asset amount is 19,000. This provision for doubtful debts is a item of liability. For a better presentation, they have shown it together. But now we have to treat them as two different items. One as an asset, another as an liability. Then there is cash. Okay. So how many type of assets? So 1, 2, 3, 4, 5 assets are there. Should we transfer all 5? No. Just go to the steps and see. We should not transfer cash and bank balance. So if we omit the cash balance, there are only 4 assets in his balance sheet. These are all the 4 assets. Now we have to transfer these 4 assets to the realization account. We have to pass one journal entry. So before that journal entry, let's see what are the assets. Plant and machinery 40,000, patents 6,000, stock 25,000 and sundry debtors 19,000. Okay, so now we have to pass a journal entry. What is the format of a journal entry? Journal of Fast and Quick I am preparing. First we have to put the date and particulars and ledger folio, debit and credit. We cannot mention, but we will leave a column ledger folio because that's the format of it. The firm is dissolved on 1st January 2012. So what is the balance sheet date? It is 31st December 2011. So we can write that on 1/1/2012. So the date of journal entry we can mention 1/1/2012. And what will be the journal entry? You have to debit the realization account. So debit the realization account, and you have to say debtor, realization account debtor. So what was the first asset we had? We had plant and machinery account. So we'll first create the plant and machinery account. The amount of plant and machinery we are transferring, crediting the plant and machinery account by 40,000. This ledger account will be closed because the balance will become zero. It has to be transferred to the realization account. So our next asset is to practice account. Amount of practice 6,000. So we'll hit by 6,000. Then third asset we had was to stock account. The amount of stocks we had 25,000, and the fourth asset was sundry debtor. How much? 19,000. So what is the total? If you do the sum total of this, it is 90,000. That should be transferred to where? It should be transferred to the realization account. So what is the narration? Being transfer of, just put an appropriate narration. There is no hard and fast and rule, but here the narration should essentially say what we are doing. Step 1, account resolution. Transfer all assets except cash, and we have done. So what we need to do then we have to look at the liabilities side of the balance sheet. Except the partner's loan and capital, we have to transfer everything to the realization account. So now we look at the balance sheet liability side. The first liability is sundry creditors. So this is an external liability which we need to transfer. Then we have fast loan. Fast is one of the partner's loan we should not transfer. Then general reserve. General reserve is also, it belongs to partners, so it should not be transferred to the realization account. It's not a liability which we need to settle to the outsiders. It's only a internal things and accumulated profits. It belongs to the partners, so we should not transfer to the realization account. Then capitals. Capital accounts also we should not transfer to the realization account. And we have to be careful that I told you provision for doubtful debts is a liability. So this should be transferred to the realization account. So for step 3, we need to transfer all liabilities except partner loan and capital. So for that we have to pass a journal entry. So what will be the date? The date will be again 1/1/2012. And what we need to do, we have to debit the sundry creditors account. Sundry creditors account debtor. How much? The value of sundry creditors is 20,000 as per the balance sheet. Then we have to transfer the provision for doubtful debts. The value is 1,000. So apart from the partner's capital, loan and general reserve balance, we had only 2 external liabilities that we are transferring to realization account. So the credit goes to realization account. So what will be the total? The total is 21,000. So we have to write a narration being liabilities transferred to realization account. Okay. Are you clear? Any doubts so far? I hope things are clear to you. So again, we'll go to the steps. The step number 4. What is step number 4? Credit amounts realized by sale of assets. So now we have to see what is the amount we have realized by selling the assets. So we have got that plant and machinery 45,000, stock 22,000, sundry debtors 18,500. So total amount 85,500. So this is the amount we have realized by selling the assets. So we have to credit the amounts realized by sale of assets. So that is the journal entry we are going to pass now. So which account we will credit? Will go by the question they have given. In the question they have given, in the balance sheet, we have only cash account. We don't have a bank account. So we'll use the cash account to record this entry. So cash account debtor, the amount is 85,500. This is the total amount we have got by selling all the assets. And where the credit will go? The credit will go to the realization account. The amount is the same. On the credit side, we have to write 85,500. So this is the amount being the amount realized by sale of assets. Okay, so we completed this step. So we are going to the next step. Excuse. The next step is that credit the value of assets taken over by partners. In this particular case, there is one asset. Here you can see that FAST took over the patents at a valuation of 5,000. So this step is very much relevant in this problem. So we have to credit the value of assets taken over by the partner. So next journal entry is for the patents taken over by the partner. Who has taken over? FAST. So we have to debit the FAST capital account. FAST capital account. How much? 5,000. The value of patent is how much? 6,000. But at what value he has taken? He has taken at a value of 5,000 only. So we have to take the amount at which the partner is taking over the patent, not at the book value. So again we have to write to realization account credit. The amount is 5,000. What will be the narration? Being patents taken over by partner. So this entry we have completed. We have to see what is the next step. Debit the amounts for which liabilities are settled. Now we have to go and see how many liabilities we had. We had only two liabilities. One is sundry creditors 20,000. Another is provision for doubtful debts. Provision for doubtful debts is not an external liability. So we need not pay to anybody. So in terms of settlement, we would have settled only the creditors. So at which value we have settled the creditors, we have to see. So it is given that the sundry creditors were paid off creditors 20,000 and we got a discount of 5%. 20,000 into 5% is 1,000. So we got a discount of 1,000. 20 minus 1, it is 19,000. So we have settled the sundry creditors for a value of 19,000. For that we have to pass a journal entry. So I come here 1/1/2012 and the entry is we have to debit the realization account. Realization account debtor. How much? The amount is 19,000 and the credit goes to cash account. We pay by cash. So we credit the cash account an amount of 19,000. What is the narration being? Sundry creditors paid off. Paid off after 5% discount. So this step we have completed. So what is the next step? We have to debit the amount of liabilities taken over by the partner. Are there any liabilities taken over by the partner? In this problem, there is no such adjustment. So we will leave this. We'll skip this step. We'll move on to the next step. Debit the realization expenses. Are there any realization expenses? Yes, it is. The expense amounted to 3,500. So we have to pass a journal entry for the realization expenses. So what will be the entry? We'll have to debit the realization account. I think we can copy this as it is. So I am debiting the realization account by 3,500. 3,500 and crediting the cash by 3,500. Why? Because this is being the realization expenses paid. So we have completed this particular journal entry. So let's move on to the next step. Transfer realization profit or loss to partner's capital account. So this is the next journal entry. But before doing this particular journal entry, what we have to do? We have to actually prepare a ledger account of realization account. Then only we will able to find out what is the profit or loss. Journal entries we have passed. From this we have to prepare the ledger account. So how the ledger account of realization account will look like? It will look like this. So we have to first write down ledger of fast and quick, then debit and credit, and the name of the ledger account is realization account. And the ledger also will have the date, particulars, amount. This is for the debit side, and date, particulars, amount is for the credit side. So we have to prepare a realization ledger account in this particular format. Once we prepare this, we have to start posting the journal entries. So first we'll move on to the first journal entry. What is the first journal entry? Realization account debtor 90,000 to plant and machinery account 40, patent 6, stock 25, sundry debtors 19. So this one we have to transfer it to the realization account. So I'm just copying this and posting here. So in the realization account, I have to debit the plant and machinery account, patents account, stock account, and sundry debtors account. The amounts are respectively 40,000, 6,000, 25,000, and 19,000. So I'm pasting the values also here. So plant and machinery 40,000, patent 6, stock 25, sundry debtors 19. So first journal entry is posted to the realization account. Then second, sundry creditors and provision for doubtful debts. So these will be credited to the realization account. So I am taking and pasting here. The first thing is by sundry creditors. By sundry creditors. And here by provision for doubtful debts. What were the amounts? Amounts I will take it 20,000 and 1,000. So I am crediting the realization account by 20,000 and 1,000. So next, so two journal entries I have posted. The third is to cash account to realization account. So by cash account 85,500. This is the assets realized. I have to write by cash account 85,500 being the assets realized. So third journal entry I have posted. Again, fast capital account 5,000. So it will be credited here by fast journal, by fast capital account. What is the amount here? It is 5,000. This is for the patents he has taken over. So this journal entry is posted. After that, I am going to realization account to cash account 19,000. This is the liabilities settled. So I am posting this entry by liabilities settled. Realization account to cash account. Also 19,000. And next account is realization to cash account 3,500. This is the realization expenses we have to debit. The amount is 3,500. So now we have to total these amounts. So I'll just do a sum of all these. $1,12,500. Similarly, I have to do the sum of this. So I see that on the debit side, I've got 1,12,500. On the credit side, I have got only 1,11,500. So just tell me whether this is a realization profit or realization loss. Debit side is more than the credit side. It means it's a realization profit or realization loss. It is a realization loss because debit side is more. It is like a profit and loss only. There is a side is more, it is a loss. So what we have to do, we have to transfer this loss to fast capital account and by quick capital. So what is the total loss? The total loss is 1,000. Who will share this? Fast and quick has to share this realization loss. So at what ratio they have to share? They have to share the profits or losses in the ratio of 3:2. So now I'm going to check the step. What is that? Transfer realization profit or loss to partner's capital account. So this I need to pass one journal entry. I know that the total to pass. How to transfer this? I have to debit fast capital account. And I have to debit quick capital account. The credit will go to realization account to realization account. So the total loss is 1,000. The entry is being realization loss transferred to partner's capital account. Now we have to see the profit sharing ratio. The profit sharing ratio, fast take 3 shares and quick takes 2 shares. So the total number of shares is 5. So How I distribute the loss? First will take 1000 into 3 divided by 5. So 3/5 of the loss goes to fast. So the quick takes a loss of 1000 multiplied by 2 divided by 5 shares of losses. So fast capital account will be debited by 600, quick capital account will be debited by 400. So this step we are now doing. This journal entry is passed. Now I'm going to the ledger account. There I mentioned fast capital account 600, quick capital account 400. Now you can see that realization account is balanced. So this step is over. Then what is the next step? Repay the loans from partners and repay the capital of partners. And if there is any deficiency, recover from partners. So repay loans from partners. Is there a loan from partner? Yes. There is a loan from partner. Fast loan 10,000. So what we need to do? Now we have to pass a journal entry for this. 1/1/2012. Fast loan account to cash account. So we debit the loan account of Mr. Fast for an amount of 10,000. So it had a credit balance. Now we are debiting it. It will become 0. So being Fast loan repaid. So this will be the journal entry. His loan is repaid. Then what next? The next is repay partner's capital. So we have to repay the partner's capital. But the partner's capital balances would have changed. Why it has changed? Because there is some patents taken over by Mr. Fast. After that, there is a realization profit or loss. So these two transactions has to be updated with the balance which is given in the balance sheet. So what we need to do, we have to prepare partners capital account. Once we prepare partners capital account, then only we will know how much we need to repay. So let's move on to partners capital account. So we'll prepare a ledger account saying ledger of Mr. Fast and Quick. So on the debit side, we will have date, particulars, and Fast capital and Quick's capital. And on the credit side also we should have date, particulars, Fast capital, and Quick's capital. Like this, we should have the format. So now we have to start with the balance which is given in the balance sheet. In the balance sheet, Fast capital has a credit balance of 30,000. Quick capital has a credit balance of 25,000. So what will be the entry? By balance brought down. This is the opening balance of capital. He had an amount of 30,000 and he had an amount of 25,000. Now we have to search in our journal entries wherever partners capital account is involved. Here nothing, here nothing, here nothing. Here we have Fast capital account 5,000. We are debiting Fast capital account 5,000. So what we need to do? Here we have to debit him to realization account. Fast has taken over an asset for 5,000. Then we have to move on to check in the other journal entries. Here we have Fast capital 600, Quick capital 400. So these entries we have to debit to the partners capital account. Again to realization account. In exams you can probably write here, this is patents taken over. patents taken over. And here you can write realization loss, so that you will also understand and you will get the step marks as well. So it's a realization loss. How much? Fast takes a realization loss of 600 and Quick takes a realization loss of 400. So we have to post this to the partner's capital account. Now we have to see, are there any other journal entries? No. Now we have completed all the journal entries, but you have to see the liability side. We had one general reserve. So this general reserve should be credited to the partner capital accounts in the profit sharing ratio. Since we are closing down the partnership firm, we have to close down this reserves. Everything we have to transfer to the partner's capital account. So what will be the entry here? General reserve account will be. So general reserve, it has a credit balance. Now we have to debit it. So we have to debit the general reserve. So the general reserve amount is 10,000. So it will become 0. Now we have to credit fast capital and quick capital. So in which ratio? 3:2, profit sharing ratio. So you will get 6,000, you will get 4,000. So this is being general reserve transferred to being general reserve transferred to partner's capital account. So this entry we have to post it to the partner's capital account. So the opening balance of 30 and 25,000, and by general reserve he gets an amount of 6,000, he gets an amount of 5,000. So now we have to total it down. 36,000, 30,000. Here 5,600 and 400 only. Now we have to balance this. Sorry, here it is 4,000, 6,000 and 4,000. So now we have to see that our credit side is more. So we have to pay. How much we have to pay? We have to pay a cash amount of 36,000 minus 5,000 minus 600. So we have to pay him a cash of 30,400. In the case of Quick, how much we need to pay? We need to pay him an amount of 29,000 minus 400. We have to pay an amount of 28,600. So for this we have to pass the journal entry. Are there any deficiencies? No. What is deficiency? If a partner's capital account has a debit balance, then it is called a deficiency. Here both the partners have credit balance. There is no deficiency. So now we'll move on to poster. We pass the journal entry. What will be the journal entry? We have to debit fast capital account 30,400 and Quick's capital account 28,600 to cash account. So the final entry for closing down the capital and cash account is fast capital and Quick's capital to cash account. So fast capital, how much we have to pay? We have to pay him an amount of 30,400. Quick, fast 30,400 and Quick 28,600, and total amount of cash paid is 30,400, 28,600. Totally 59,000 should be paid to both the partners. we pay 59,000, all our accounts will be closed down. So any doubts so far? So being partners capital repaid. Now we can post all these entries in various ledger accounts. We can see that the books of the firm is closed. So let's move on to the ledger accounts. So first realization account we have completed. Then partners capital account we have completed. We will take up the other ledger accounts one by one. So plant and machinery account. What is the balance of plant and machinery account? Plant and machinery initially had a balance of 40,000. Since it's an asset, the opening balance will be a debit balance. So by balance brought down. What is the amount? The amount is 40,000. The total also will be 40,000. So credit side total also will be 40,000. What happened to this 40,000? We have transferred this to realization account. So what we will write here? We'll write by realization account. By realization account 40,000. So we had an opening balance of 40, transferred everything to realization account. So there is no balance remaining. So this account is closed. Then the next asset, sundry creditors. So we are taking the sundry creditors here. Sundry creditors account. So creditor, so there will be a by balance brought down. By balance brought down. The amount is 20,000. The total will also be 20,000. So debit side, there's 20,000. What we have done this, we have transferred to realization account. You can see that we have transferred to realization account 20,000. So this account is closed now. And fast loan account. So fast loan account, 10,000 was the balance. So by balance brought down. The credit balance by balance brought down. We had an amount of 10,000. So the total is also 10,000. What we have done, we have paid by cash. You see the journal entry, fast loan to cash account 10,000. So here we'll have the to cash account. To cash account, how much we have? We'll have an amount of 10,000. So this account is closed. So similar to plant and machinery, you will have you can open patents account, stock account, sundry debtors account. All these accounts you will have the by balance brought down and by to balance brought down and by realization account. Similar way you can post all these ledgers, it will become 0. So then we will move on to the cash account. So in the cash account, what are the transactions? We'll see the journal entry. The first thing will be to balance brought down. Balance brought down. How much is the opening balance of cash we had? In the opening balance of cash we had 6,000. So opening balance will be 6,000. Now we have to see the journal for various other entries involving cash. Here cash not involved, here cash not involved, here it is involved. So cash account to realization account 85,500. So what we will do is to realization account by selling the assets we have got 85,500. It is debited to our cash. Then fast capital to realization, no, here it is. By realization account 19,000. So by realization account, how much? 19,000. This is the sundry creditors repaid. So realization account to cash account 3,500. Again, realization account. This is for the realization expenses paid. How much? 3,500. And cash not involved, but here cash is involved. What happened? Fast loan to cash account. We have repaid fast loan by cash. The amount was 10,000. And anything involving cash? Yes, here it is. Fast and quick capital accounts. Fast and quick capital accounts. It is 30,400, 28,600. If you see that now cash balance debit side 91,500 and credit side also it is 91,500. So cash is closed. So by this you can see that realization account is closed by transferring to partners capital account. Plant and machinery closed by transfer to realization. Sundry creditors closed by transfer to realization. And for loan closed by transfer cash account transferred by transferring to partners capital account is already closed. We have seen. So now all the asset accounts, all the liabilities account, partners capital account and partners loan account, cash account, bank account, everything is closed. So by doing this 11 steps in this particular problem, we are able to close the books of accounts of Mr. Fast and Quick. If anybody is asking journal entries, this is how we have to pass the journal entries. If anybody asks ledger accounts, this is how we prepare the ledger accounts. This is the partners capital account. So this is how we deal with problems of dissolution of partnership firm. So it's a basic example to just demonstrate the various steps involved and how actually it happens. So are you clear about these steps involved now?
Yes, sir.
Okay, thank you. Take note of these steps. This we have to compulsorily memorize. Once you know these steps, then only you will be able to solve the problems of dissolution. Anyway, this Excel sheet I will be sharing with you guys after the chapter is over, not before that. Once the chapter is over, I will share this Excel file with you guys. So you need not worry, but for the time being, you can just read the various steps. What we have done, first we have opened a realization account, then we have transferred all assets except cash and bank, then we have transferred all liabilities except partner loan and capital, then we have credited released by assets, credited the value of assets taken by partners, and they debit the amounts for which liabilities are settled. The next step was not there, we did not do that. Then we debited the realization expenses, then transferred the realization profit or loss to the partner's capital account, and we repaid the loan from partner and we repaid the partner's capital. By doing all these 11 steps, we were able to close the books of a partnership firm. So if there are no doubts, I think we can go for 10 minutes break and we will rejoin exactly after 10 minutes. Is it okay?
Okay.
Yes, sir.
Thank you. Thank you. So let me share the screen now. So we have completed this first sum fast and quick. Now we'll move on to the next problem. Can anyone volunteer to read this question? Illustration number 1. Can anyone read this problem? Are you guys there? I'm not sure. There is no response absolutely. Any one volunteer who can read this question? Illustration number 1, page number 14.
So, X, Y, and Z are the partners of firm X, Y,
Yes.
Z, and
Who is that?
Gautam, sir.
Yeah, sure.
X, Y, Z are the partners of the firm X, Y, Z, and Co, sharing profit and loss in the ratio of 4:3:2. Following is the balance sheet of the firm as on 31st March 2021. Balance sheet as on 31st March 2021. Liabilities: partners capital X 4 lakh, Y 3 lakh, and Z capital is 2 lakh. General reserve 90,000, sundry creditors 3 lakh 20,000, total 13 lakh 10,000. Fixed assets 5 lakhs, stock in trade 3 lakhs, sundry debtors 5 lakh, cash in hand 10,000, total 13 lakh 10,000. Partners of the firm decided to dissolve the firm on the above date said date. Fixed asset realized 5 lakh 20 and book debts 4 lakh 20, 4 lakh 40. Stocks were valued at 2 lakh 50 and it was taken over with partner Y. Creditors allowed discount of 5% and expense of realization amounted to 6,000. You are required to prepare realization account, partner's capital account, and cash account.
Thank you. So we are moving on to the next problem. Again, this is a partnership firm, but 3 partners are there. 3 partners, X, Y, Z. They have their capital accounts, but there are no loan accounts from partners. There is a general reserve which should be transferred to the partner's capital account. As far as external liabilities are concerned, only sundry creditors is there. On the asset side, they have 4 assets. One is fixed assets, stock in trade, sundry debtors, and cash in hand. As far as realization account is concerned, only we have 3 assets. Cash should not be transferred to the realization account. So the balance sheet date is 31st March 2011 and they want to dissolve on the same date. And fixed assets realized were 5,20,000, book dates 4,40,000. One of the asset stocks, it was taken over by partner Y at a valuation of 2,50,000 only. And as far as creditors are concerned, we have paid the creditors, but after taking a discount of 5%, and there is a realization expenses of 6,000. So what is required? No journal entries required. So absolutely no journal entries. So straight away we will move on to the ledger accounts. Now we are sure how to prepare a journal entry and how to post that into ledger account. So we will skip that initial part of preparing the journal entries. We will straight away move on to the ledger accounts. What are the various ledger accounts required? We need not prepare all the assets and liabilities ledger accounts. because they ask only 3 ledger accounts. One of the ledger account is called realization account. Another is partners capital account, and finally cash account. Only 3 ledger accounts we are going to prepare. So now we will refresh our memory. What are the various steps? So first thing is to open a realization account. So what we will do, we'll skip this journal part. We'll move on to the ledger account, the realization account. So what will be the format of this realization account? The realization of account format will be ledger of X, Y, Z and Co. On the debit side, we'll have date, particulars, amount. On the credit side, we'll have date, particulars, and amount and credit. So this is the realization account format. So in this format, we have to straight away start with the entries. Then we have to prepare partners capital account as well. So partners capital account. So how many partners we have? In this question, we have 3 partners, X, Y, Z. So the ledger of X, Y, Z will open the partners capital account. This is called columnar capital account. Means we will not prepare 3 different ledger accounts. In one ledger account, we'll create one column for each of the partners. So on the debit side, we have date, particulars, X capital account, Y capital account, and Z capital account. So on the credit side, again, we have date, particulars, X capital account, Y capital account, and Z capital account. So this is the format of capital account. Then what else we need? We need one cash account. In this, we have to see whether they have a cash account or bank account. In this problem, they have given cash in hand. So we'll start with the cash account, a ledger account for cash. So again, it will have columns debit, credit, date, particulars, amount. So this is the format of cash account. So I have prepared the formats. Now what we need to do, I have to follow the steps. So I have the steps. So first I will start with the realization account. Open realization account. I have done it. I have opened a realization account. Next, what I need to do, transfer all assets except cash and bank balance. So I'm looking at the balance sheet. I have 4 assets except cash and bank. I'm going to transfer 3 fixed asset, stock in trade, and sundry debtors. So now I'm going to transfer these to realization account. How to do that? We have to debit to fixed assets. I'm making it short because I don't want to waste too much of time in formatting and other stuff. Our main focus is on learning the concepts and flow of things. Okay, so to fixed assets, 5 lakh I'm transferring to realization account. The amount is 5 lakhs. Then second asset, what I have is stock in trade 3 lakhs. So to stock, the amount of 3 lakhs I'm transferring. So third asset is debtors. So the debtors amount is 5 lakhs. So I'm done with the step number 2. I have transferred all the assets except the cash and bank balance. Then what I need to do, I have to do transfer of all liabilities except partners, cash, loan and capital. So I see the liability side, I have only sundry creditors. So what I'm doing by sundry creditors. The amount of sundry creditors is 3,20,000. So this I have transferred to realization account. Then I am going and checking what is the next step. Credit amounts realized by sale of assets. So I am going to see, I had 3 assets. I have to see how much I have realized by selling them. So fixed assets 5,20,000, book debts 4,40,000. So I have to see by cash. How much I got? By selling the fixed assets, I have got 5,20,000. By selling the debtors, collected 4,40,000. So in total, I have got a cash of 9,60,000 because realized 5,20,000 and 4,40,000, 9,60,000. Okay, so this step I have completed. So I'm moving on to the next step. Credit the value of assets taken over by partners. In this problem, one of the partners, Mr. Y, has taken over stocks for a value of 2,50,000. So what should I do? I should move to the realization account and I have to write by Y's capital account because he has taken over the stock of 2,50,000. Entire stock he has taken over, but only at the value of 2,50,000. So we are doing this. So I have done this. Then what I need to do? Debit the amounts for which liabilities are settled. I had only one liability. At what amount I have settled it? So creditors I had 3,20,000. I got a discount of 5% and I settled the balance. So what should I do? Now I have to go to the realization account and to debit the cash account by how much? 3,20,000 minus 3,20,000 into 5%. So basically 3,20,000 and 5% of 3,20,000, 16,000 is the discount. So net amount 3,04,000. I have settled my creditors. Then what I have done? There is a realization expenses of 6,000. So let me check the steps. What I should do next? Debit the amount of liabilities taken over by the partner. There is nothing like that. Then debit the realization expenses. Are there any realization expenses? Yes, 6,000 is the realization expenses. So I should go to the realization account. I should debit the cash for the realization expenses incurred. The total amount of realization expenses 6,000. So this I have completed. Okay, next what I need to do? Next the capital account. So I have to balance this account. I have to balance this realization account. I have to transfer it account. So how I do this? I do a sum total. I am totaling all the items in the debit side, which comes to 16,10,000. And similarly, I do the sum total of all the items on the credit side, which is coming to only 15,30,000. So my debit is more, credit is less. So what I have got? I have got a loss. How much loss I have got? Debit 16,10,000 minus credit 15,30,000. So 80,000 is the loss I have. So 80,000 I have. What I should do? I have to transfer this to partners capital account. How many partners are there? By partners capital accounts. How many partners are there? 3 partners are there. Who are they? The first partner is called X. The second partner is called Y. Third partner is called Z. There are 3 partners. Now these partners only have to bear the loss. What is the total loss? The total loss is 80,000. How much I should transfer to X, Y and Z? I have to see the profit sharing ratio. The profit sharing ratio given is 4:3:2. So I am taking 4, 3 and 2. So the total number of share is 9. So I have to proportionately transfer the loss. So total loss is 80,000. So total loss is 80,000. Out of this, Mr. X will take how much? He will take an amount of 4 divided by 9. So he will take a loss of 35,556. And second partner is Y. Y will take a share of 80,000 multiplied by 3 divided by 9. And third partner Z. He will take 80,000 multiplied by 2 divided by 9. So he will take a loss of 17,778. So now if you do the sum total up to 53, you have to do 52. This is a circular reference, so 52. So now we can see that our realization account is balanced. There was a loss of 80,000 which we have transferred to the partner's capital account. So what is the next step? Once we complete this realization account, then we have to move on to repay loans from partners. Are there any loans from partners? I don't see anything, so I will skip this step. So then repay partners capital. So first of all, I have to update the partners capital. Then only I will know the balance for which I have to pay the cash. So now I will move on to partners capital account. I will start with the opening balance. So by balance brought down. How much is the capital I have? The opening balance of capital is X 4 lakhs, Y 3 lakhs, Z 2 lakhs. So 4, 3, 2. So 4 lakhs, 3 lakhs, and 2 lakhs. So I have brought the opening balance. So then what next? General reserve. What we need to do? The general reserve we have to transfer to the partner's account by general reserve. We have to transfer to the partner's capital account. 90,000 into 4 divided by 9. And here 90,000 into 3 divided by 9. And he gets 90,000 multiplied by 2 divided by 9. So general reserve is transferred to the partner's capital account in the ratio of their profit sharing ratio, which is 4, 3, 2. So 4 by 9, 40,000. 90,000 into 3 by 9, 30,000. 90,000 into 2 by 9, 20,000 is transferred to the partner's capital account. So what else I need to do? I have to see what are the other adjustments. In the ledger accounts, we have seen that partners' capital accounts are involved in two places. One is the stock taken over by Mr. Y. So we have to write to realization account. To realization account. Stock taken over by Y is 2,50,000. We have to debit him. And similarly, there is a loss on realization. So loss on realization, how much? You have to see that in the ledger. It is 35,556, 26,667, and 17,778. So we have to take this and we have to post it here. I'm copying here, pasting here, alt. Okay. There is some hidden column. So I better do this. The link of the cells 35,556 and 26,667 and 17,778. So this is the realization loss, the total amount of 80,000. So what I need to do, there are no other entries or adjustments. So I have to balance the capital accounts. So this credit side is more 4,40,000. This again credit side is more 3,30,000. Again credit side is more 2,20,000. There are no deficiencies. What is deficiency? If any partner has debit side more, then it is called deficiency. Here all of them have credit balances, no deficiency. So this is also a simple problem. So what I will do, I will transfer the balance to cash. I'm paying them by cash. What I should do, the total is 4,40,000 minus 35,556 realization loss. I have to pay him an amount of 4,04,444. If I do this similarly, total is 3,30,000. Out of that, he has taken stocks worth 2,50,000. There is a loss of 26,667. So a balance of 53,333 is the amount to be paid to Mr. Y. And in the case of Z, he has a credit of 2,20,000, debit of 17,778, net balance is 2,02,222. This is the amount should be paid to him. So we have done one, the realization account, two, the partner's capital account. So the partner's capital account we have completed. What else is remaining? The remaining is that we have to move on to the cash account. So we have to post all the relevant entries in the cash account, then it will be over. So in cash account, what we need to see, in the cash account, we have to take the opening balance. How much opening balance we had? We had an opening balance of 10,000. What we should do? We should take it to the opening balance. To balance brought down. What is the amount of balance? It is 10,000. So what is next? What is the next thing we need to do? We have to post all the entries. So we have to check the other ledger account we have. We have done totally 3 ledger accounts. We are done with the rate. If we post the entries involving cash, then we'll be finishing with the cash account. What are the other balances? So here we have a cash of 9,60,000 by selling the fixed assets and realizing the debtors. We have got 9,60,000 cash receipt. So what we need to do, we have to write by realization account. How much? 9,60,000 we have got. And what we need to do, we have to see the debit side of realization account. Here we have couple of entries. One for the settlement of sundry creditors. The other one is to pay the realization expenses. So what we have to write? We have to write by realization account. At what amount we have settled the creditors? We have settled the creditors for an amount of 3,04,000. That payment we have to credit here. Then what we need to do? We have to credit the realization expenses paid in cash. So this is done. So what else is remaining? We have to check the capital accounts of partners. So here only one entry involved. We have to say X capital account, Y's capital account, and Z's capital account we have repaid. So what we need to do? By X capital account, by Y's capital account. and by Z's capital account. So X, how much should we pay? Can any of you tell me how much we have to pay to Mr. X? Repayment of capital. Any doubts so far? Why no answers? How much should pay? You have to pay him an amount of 4 lakh 4,444. But just seeing the screen and have to say the answer, nobody is saying. So for X, we have to pay 4,04,444. For Y, we have to pay 53,333. And for Z, we have to pay 2,02,222. So now we are done with all the entries. We have to total the debit side and credit side. So now I am doing the sum of the debit side. How much it is? 9,70,000. And similarly, I am doing on the credit side. Sum total of all these amounts. I see that my debit side and credit side totals are equal. It means I'm not left with any closing balance. So now I could see that my realization account is closed, cash account is closed, and partners capital account is closed. So all the assets, liabilities, cash account, partners capital account, everything is closed. So my books of accounts are finally closed. So any doubts or questions?
No, sir.
Yes. These problems are very, very simple and elementary, provided you know the steps. So I have given the list of steps. Once you memorize these steps and practice 1 or 2 problems yourself, then it will be very, very easy and cake work for you. So this is the dissolution of partnership firm. We have started with some very simple problems. Now we will be moving on to the more advanced or complicated problems. So what is next? Next we are going to study about a concept called insolvency of a partner. So what is an insolvency? I have explained you that if any person's liabilities are exceeding the assets and if he is not able to repay, he will get the protection from the court. He will go to the court and he will ask court's protection from the creditors' recovery efforts and follow-up actions. So then the court will grant him a safety, saying this person has become insolvent. His liabilities are more than his assets. So I will appoint an official liquidator. So he will take over the assets and liabilities of this person. No creditor should disturb him going forward. So such a protection will be given to the person. So if such a thing happens in partnership firm, what happens? Towards the partnership firm, his liability is unlimited. But as soon as a partner becomes insolvent, he stops being a partner. So the partnership firm cannot receive any money from partners' private assets. So there are a lot of complications involved. So what are the consequences? If a partner goes insolvent, the following consequences arise. 1. The partner adjudicated as insolvent ceases to be a partner on the date on which the order of adjudication is made. So from that day onwards, he stops becoming a partner. Next, the firm is dissolved on the date of order of the adjudication unless there is a contract to the contrary. Usually when there is a insolvency of a partner, the firm itself is dissolved, not only the partnership. But if the partners, other remaining partners are willing to continue the business, and there is a agreement also to continue the business, even one partner becomes insolvent, then they continue the firm. Otherwise, the firm itself will be dissolved. And third thing is, the estate of the insolvent partner is not liable for any act of the firm after the date of that order of adjudication. And the firm cannot be held liable for any acts of the insolvent partner after the date of the order of adjudication. So these are the consequences. So what happens is, sometimes there will be a loss arising from insolvency of a partner. When such a loss arises, for example, his capital becomes negative. In those cases, what to do? So usually any profit or loss in a partnership firm is generally shared in the profit sharing ratio. But insolvency loss is not shared in the profit sharing ratio. It is shared in a different ratio. Let us see what is that ratio. Insolvency of a partner arises when partner could not repay his liabilities. And after adjudication of a partner as an insolvent, the insolvent ceases to be a partner. In case there is no agreement to carry on the business, the firm is dissolved. Partner is not liable for any act of the firm. Firm is not liable for any acts of the insolvent. So now we are moving on to loss on insolvency. That is, the partner's liability in the firm exceeds his credit balance. Then his capital becomes a debit balance. He has to bring the money from his private assets. As he is already an insolvent, he cannot bring any money from private assets. So this loss is called loss on insolvency. And there are two methods to deal with this loss on insolvency. What are the two methods? There is a method one, which is as per partnership agreement. So in partnership agreement has to say that if any person goes on it, becomes an insolvent, how the loss on insolvency should be treated. If such a clause is there in the partnership agreement, then we have to go by that particular method. This is called a method one, and it is very rare. Usually the partners think about doing the business in a profitable manner. They will not think about what happens in case there is an insolvency, what happens in case there is a loss on insolvency and all. These are far-fetched. So most of the partnership agreements are silent on this respect. So this kind of treatment is rare. But still, as a legal methodology, this method is there. And there is another method, which is Garner versus Murray method. This Garner versus Murray rule is the most of the time examination questions also will come only as per this particular method. So how we deal with the loss on insolvency under this method? Here what we do is, loss on insolvency should be borne by the remaining partners in their ratio of capital. So here we are not looking at the profit sharing ratio. If there are three partners, let us say A, B and C, if they share profits and losses equally and C becomes insolvent, the remaining partners are A and B. Who are called remaining partners? If you exclude the partner who is an insolvent, the others are called the remaining partners. So in the example A, B, C becomes insolvent. So A and B are called the remaining partners. So if there is a loss on insolvency, who should bear that? If they have shared the profits and losses equally, should we go by the same methodology? No. Loss on insolvency, we go by the ratio of capital. Let's assume A has a capital of 1 lakh, B has a capital of 2 lakhs, and they share the profits and losses equally. Then we have to go by the ratio of their capital. If the loss on insolvency, 1/3 will be taken by the Mr. A and 2/3 will be taken by Mr. B. And next thing is, even one more advanced situation is that some of the remaining partners, they have capital in debit. Then what happens? Then he need not bear loss on insolvency. Let's assume there are 3 partners. As I told you, we have 3 partners, A, B, and C, and they are sharing profits and losses equally. Let's say 1:1. This is called equal, and C becomes insolvent. Then the remaining partners are A and B, and the profit sharing ratio will be 1:1. In a situation when both of them have credit balance, for example, he has a credit balance of capital 1 lakh, this guy has a credit balance of 2 lakhs, then the loss on insolvency should be shared in the ratio of 1:2. But in another situation, let's assume C is insolvent, A and B are remaining partners, and A's capital is minus 10,000. His capital is in debit balance minus 10,000. His capital balance is 1 lakh, positive balance. Then who will share the loss on insolvency? Entire loss on insolvency. Whole loss on insolvency is should shared by the remaining partner who has credit balance in capital. So this is the concept. So several things we have studied. First is what is insolvency, and what are the insolvency, and how many methods are there. There are 2 methods, and Garner versus Murray rule is the very famous method. According to this, loss on insolvency should be borne by the remaining partners in the ratio of capital. If some of the remaining partners has capital balance in debit, then he need not bear the loss on insolvency. Then further we have more complications. What are the more complications? Capital ratio for Garner versus Murray rule. Then what happens? We know it is should be as per the capital ratio, but how to find out the capital ratio? There are 2 cases. One is fixed capital. What is a fixed capital? In these particular cases, the capital of the partners will remain fixed. Any interest on capital, interest on drawings, all those things will be routed to the drawings account, not from the capital account. So this is called a fixed capital. If the partners' capital are fixed, then the ratio of capital for the purpose of loss on insolvency will be the fixed capital ratio. The another is, in this particular case, there are 2 accounts. One is capital account and one is a current account of partners. So all the transactions of the partners will be routed through the current accounts. Fixed capital account will remain fixed. So in these cases, the finding out the ratio is very easy. We can straight away take the fixed capital ratio. But the second case is fluctuating capital. In these cases, partners don't have separate current accounts. All the transactions of the partners, like their drawings, interest on capital, interest on drawings, all those things will be done in their capital account itself. So the balance will keep on fluctuating. So in these cases, how to take the capital ratio? So they have given a solution saying you have to update the fluctuating capital account to the date of dissolution. Whatever transactions, we have to update the fluctuating capital. Then we have to take the balance of fluctuating capital as on the date of dissolution, and that particular ratio we have to use it for sharing the loss on insolvency. So this is one concept based on which we'll be seeing some a little bit advanced problems. So whatever we have seen is a very simple problems. We'll see some little bit advanced problems in next class, that is tomorrow. So tomorrow morning we'll have the class at 6:30. In that class we'll see how to apply these concepts. regarding insolvency, loss on insolvency, Garner versus Murray rule. So these things we will practically see how to apply them in real-time situations. Any doubts or questions so far?
No, sir.
Okay, thank you. If there is no questions, then we can wind up today's class. Thanks for joining. So tomorrow class will be at 6:30. We will continue with partnership accounts tomorrow. Thank you.
Thank you, sir.